Rohit, welcome back.
Hi,
How are
Dale.
you?
I'm good.
So, how's the power situation there in Mumbai?
Perfect. It was a 2-day problem, just temporary, but
Okay,
resolved.
because you probably need air conditioning, right?
Yes, definitely.
Was it bad that day without power?
It's 33 degrees centigrade. I don't know how much that's in Fahrenheit, but it's hot.
Yeah. All right. So, I was just commenting with all the global bourses really on fire. The Nifty hasn't made new highs, has it?
Yeah, the Nifty has been an odd boy. But it had its moments because when everything was down, when the chips were down, it actually made a new all-time high in December.
Why don't you share your charts, please, Rohit?
I'll do that.
Yeah.
So I have the presentation.
Because we're getting new recovery highs across the board, and this is the only one so far, right?
Right. So I have a presentation, but taking the discussion.
Okay.
So this is the chart. We did actually pretty well last year to December. So we made an all-time high here. And then from here, we started to deviate with the world market. So even as Asia and Europe started to recover in January, India just went into a limbo, partly because there was this Adani scandal. Then there was the annual budget. But I think the scandal played a bigger role in dumping the sentiment. And then from there,
the scandal with Modi?
No, not directly with him, but the Adani group has been closely associated with Modi. But there was a Hindenburg research report saying that they're not doing things right, which is still being investigated.
Okay.
But that caused the Adani stocks to fall 60-70% in 2-3 days, and that sort of rubbed off badly.
Okay. It was like
so since then, since Jan, India is sort of deviated from the world markets or Asia and, fell on its own, was not participating. But from March, which is also a seasonal period, usually we've seen like March 2020 was a bottom. We've had previous seasonal bottoms in the month of March. So that was a very interesting period. We also had a huge short positioning, just like we have in the US. We had a max short positioning from, domestic funds. Which also indicated that maybe we get a recovery rally, which is what we've had since the low in March. So April was good. May has also seen a recovery. I'm sensing it continues till at least the end of this month, early June. And then we watch out for the next set of resistance levels. So we have started to move up. I think I'm not ruling out we'll head towards all-time highs again, along with the global rally that is going on. So just to take it to the charts, what I've put together here. I think even one of my previous presentations, I said fear, and apparently after 6 or 8 months we speaking, fear is still high. Fear is pretty high on what will happen specifically with US, not in other markets. I think the fear is less in other markets, but everybody is pointing US banking sector, US debt ceiling, and that sort of has worry lines, and the fear that a recession may show up. And I've sort of fought that out with data points that I'll go over and charts. And so essentially focused more on the momentum and sentiment. And that I think has helped us navigate the course better than simply going with the narratives. Now, of course, positioning. So there are two things in positioning that show this fear. One is the largest short position in the bond market, which is a surprise. And it's remained prolonged. It's not yet caused a significant rally, but it's been prolonged. I sense we are close to ending, starting a good move to the upside in the bond market, which means yields should start dropping soon. Not immediate, maybe in a week or two, we should start seeing that move develop. And the same thing,
they're going to squeeze the record shorts.
Yeah.
Okay.
Because it's a second wave, we'll look at that chart. And similarly, in the US equities also, we have a huge short positioning. Indian short positions are pretty much cut out in this rally. This last 1.5 month rally, they are down to zero. But apparently in the US, they are adding shorts over the last 3 weeks. and it went to a new high first to the 2011 highs. Now you're, I think, close to highs seen only in 2008. So this is now become the highest in a decade.
Okay.
Now, is this really justified? So as I listen to a lot of the arguments which are around the potential that, well, this is how the cycle plays out, which means that things slow down. And when they slow down a lot, the Fed is forced to cut. And typically when they cut, the yield curve steepens, and that's when markets fall. Now, that's what happened in 2000. That's what happened in 2008. But I tried to make sense of this simply looking at the chart of the bond versus equity, and in a different time period, which means going all the way back to 1982, 84, when you had an inflationary crisis. My sense is that 2000 and 2008, why they are different is they were deflationary crisis,
Right.
and not inflationary crisis, and which is why the reaction function of the bond and equity markets and their correlations were very, very different. So when you're looking here, I'm looking at the 10-year bond yield, and I'm looking at the S&P going all the way back. And the peak in yields, as we can see on this chart, I'll just use my drawing tools, is here. And after this peak in bond yields, probably a bit after or before this, had peaked in raising rates, what we have, the first wave down and the first pullback. I think till this point of time, equities were still falling. And then that is it. It was done. So basically, we can say once you are done with wave 2, pullback or retracement in the yields, then we were done with an equity market bottom. And after that, they were sort of inversely correlated. Yields going down, which means bonds going up. So in other words, bonds and equities were directly correlated. Bonds and equities rallied together. And that is very different from what we are anticipating right now. A lot of the positioning is anticipating that probably, and positioning is funny because it's actually anticipating the same. If you think bonds are short and equities are short, why shouldn't both rally together? This inflationary period suggests to me that that's what is the likely outcome. Both would go up together, and not an inverse correlation like we saw in 2000 and 2008, which we can then
and
look
87, 87, that was a big deal too.
Yes,
okay,
yes, that's right here. But here, so we can see that here. This is the 1987 sell-off. Yes, there was a spike in yields, but yields went up, stocks went down, and then subsequent to that, yields continued lower and stocks continued higher.
Yeah.
So again, it was yields and stocks were inversely correlated. But when we come to 2008 or 2000, both these periods, what we have seen is the function was, well, rates were raised, because of overheating of the economy, and that eventually caused the market to roll over. And when the market rolled over, you're cutting rates till the point where, and this is the part where the Fed pivots is how it's being called out, that when it pivots, that the market still falls further, because that's the recognition point that you're heading into a recession, and rates are being cut into that news flow. So this is how it's seen, that in both of these periods, rates went up, chasing as markets went up, rates continued to rise. And once again, they faltered and rates were being cut into the next recession. There was a pivot somewhere here where recession is recognized, rates are being cut, and markets continue to fall. The question is, will it follow this narrative or will it follow the inflationary setup? I am sensing it actually follows the inflationary setup, simply because what we've seen in the last 1.5 years has been a change in the model, where rates are actually going up along with equities, and rates are actually going down along with equities. So we can actually see that in this period, that the inversion happened somewhere at this point, where markets are going down with rising rates. And so, which is why I sense you could do what we did in 1982, which is, once you get this second wave, you're getting that right now, you're getting this bounce retracement in bond yields. And once they're done with that and start heading down, which should happen once your core inflation data also starts to roll over, which looks imminent, given that a large part of his rents, and rents based on other stats, which is actual online stats, are actually showing a decline, meaning that the government data has only lagged. So just going by that theory, if this is eventually going to happen, it should drive markets higher. The only impending thing is probably the debt ceiling, which mostly gets resolved in the next 10 or 10 days or so.
Okay,
so presuming
new all-time
here,
highs.
Sorry?
New all-time highs you're looking for in S&Ps.
I am not ruling out that you'll see new all-time highs on the big picture, which means do I really end the fifth wave? So it's been a mental debate for quite some time, how to counter this entire move. Should we think that this is the end of this entire rally that started in 2009, or do we still have one final move left? And I'm sensing that there is a possibility there's a final move left. And we've not broken this. This is, of course, the Nasdaq. We haven't broken this channel line temporarily, yes, but not strongly enough to say that it's reversed. The fall from the 2022 high to the bottom completely overlaps each other, which means it's not a 1, 2, 3, 4, 5 impulse, which I could say is A, then B, then C, but instead it's a complex correction, which therefore can get us wrong if we think of it as ABC. It can be W, X, Y, X, Z, which then completes one segment. And sometimes when you complete such a complex segment, it can end a bear market as well. There's also similarity with, maybe to some extent, with 2000, 2008 in a different sense, not the relationship with the bond market, but economic wise, I remember that the US economy did slow down a lot into 2001, 2003. The subsequent recovery was exactly not strong. The housing bubble, in fact, was known by 2005-06, and the market was still going higher. So you had a weak recovery where neither the Nasdaq went to a new all-time high. The S&P only did a double top in 2008. So you can have an environment in which markets recover into a weak recovery, and the recession, which is being anticipated, even if it gets postponed by 5 to 6 months or a year, gives us enough energy to squeeze shorts, and you only get the weakness later on when trouble shows up at some other point of time. So that allows us to complete this fifth wave in a recovery before we actually roll over. So it could go on for longer than most people are thinking, which is now beginning to show up in the charts. There are two things I look at. One is, of course, my own momentum indicator. We've coined it the RMI, or the Rohit Momentum Indicator. It's essentially a weighted average rate of change that I've made in my own way, and it's crossed over to the bullish side on the monthly charts for the month of April. We are watching what happens in the month of May. So even though we have this bullish crossover, what is pending is that in the previous two bear markets, we also surpassed the 20-month average. So we are right now at the 20-month average. We are in the process of crossing it intra-month. I mean, we are above it now on the S&P 500 or the Nasdaq, but we want to see it stay there another 10 days to go. And if it does that, then I think that will be a secondary confirmation that we have started a recovery move. Okay. So then I have two ways of looking at this recovery. I could either think that, like I said, if it's a fifth wave, so I've tried to be open to ideas, either it's 1 and 2, or if I still argue that, okay, no, this is a bear market rally, I still want to mark it as A and B, then I can say C will have 3, 4, and 5 before it's over. And even in that case, it can almost get close to the previous highs.
Interesting. Okay. Even the bearish count is bullish.
Yeah.
Okay.
So a good channel.
Let me ask you this while you're on it, because, I talked to other Ellioticians. Yeah. And a few of them have been waiting for this 4,300 level to complete a wave before we wash out. Do you see that alternate count?
I actually do not, because by the time you reach 4,300, this advance will end up being 3 waves and not 5. And wave C should typically be 5 waves. So wave C is always 5 waves, in fact. So therefore, it wouldn't complete the structure in my mind. One can definitely argue, no, let's mark this as W, X, Y and complete it. But that would be forcing ourselves onto the market. So I think I won't take that as a conclusion. I'll really look for a clear impulse on the way down before I, call it reversed. The other thing is we also simultaneously watching not just the bond market, but we'll also be watching the dollar for the same risk environment, right? Is it rising or is it falling? And that should also give us a clue at that point of time.
Yeah, the dollar's had about a decent week and a half bounce. It didn't bother the market at all. It bothered gold, it bothered commodities, but not equities.
Yes.
So you could continue.
So this is broadly the setup. Hedge funds positioned short on bonds and equities, which logically should mean that both rally. But the expectation is that bonds go up and equities go down. And we have listened to so many people say that if they're negative on the market, they might as well buy bonds, but sell maybe the Russell 2000. So two of the indices I was watching over the last couple of days was actually the Russell. And so before I come to Indian equities, I'll just show you that chart. This is, of course, the bond chart. So this is how I'm marking the count for the bond yields. I'm essentially looking at this being the first wave down, and we are doing a retracement. So somewhere either 61%, or best case scenario, we end up touching the top end of this channel before we start wave 3 down. That's what I'm thinking.
Okay. That's 3.9. That's a count I came up with a break over 360. It targeted 390, 395.
Right.
So you think we could go there before
it's open? It's definitely open right now till I get a reversal. Like the count here shows ABC, and it's ABC going on. As long as C is going on, I cannot preempt that it will reverse till it does.
Got it.
So, though on the other side, I am looking at the dollar index maybe completing something, possibly even today. So what I was watching for is a retracement of this fall. It could have gotten to 61% now. Intraday, we are already declining from here. What I'm looking at is ABC, where we also is looking at 5 waves. So this is A, B, and C is being 5, 1, 2, 3, 4, and 5. So this was the 5th. If it does remain down for the rest of the day, I'll presume that C is over, and possibly the bounce in the dollar index is complete, which means we could start the 3rd wave down. Now, of course, it can spend some more time here before it does that. But what I'm looking for is 3 of 3 down in the big picture.
You have targets 99, 98.
So let me just show you a big picture chart. Yeah, something like this. So looking at around 95, which to start with, which is the bottom end of this channel. Now, usually you would expect, I think if this is, I'm thinking that we've completed something inside this larger channel at the top side. So I think this is a major top here. This is possibly just the first wave bounce or consolidation. Once that is done, we'll be in the 3rd wave, can test this, but possibly break this, eventually go back to 89 or 90 down here, closer to the X line.
Yeah. Got it.
Yeah, what I can't judge right now is how much time
that'll fuel risk. And does that mean we should be buying gold and silver on this pullback right here?
Absolutely. You should be buying gold and silver, emerging markets. Some of them have already given lead signals. Others probably do so in the days ahead. So if I look at silver, I think we have an expanded flat, which means A, B, and C completing the 2nd wave. Possibly do it today if the dollar is topping out, possibly get the reversal in silver. Need to watch. I'll leave it for tonight and see if it manages a positive closing. Then I'll start anticipating a 3rd wave up. Now, it's 3rd waves at multiple degrees, right? Because I think longer term, this is also a 2nd wave. This is a 61% retracement of the entire rise that we saw in 2020. And from there, we've been trying to build into the 3rd wave. So 1st, 2nd, now it's 1 of 3, 2 of 3. So you've got 3 of 3, 4 of 3, 5 of 3. Should be a long way to go. Next move itself, I think 1-2 months should be around $28, $29. And then possibly that's your 3rd and 4th, and then the 3rd again.
Okay. This rally in US dollar yen, I would think that would have to peak to get that action in the metals. Do you think this move we recently had over 138, technically it still doesn't look bad?
Yeah, so it has some room. You're right. This is the USD JPY. I'm also taking this as a second wave, but wave C at a larger degree. So this is A, B, C. The C is not complete yet. The top end here could be as much as, what is this level?
42
Around
to
140, 41, 141 or 61% near 142.6.
Okay. All right. That's when yield should peak too.
Right.
Up there, right? So
Yeah.
if we're going to have a big fall, if that's two, then the big break is coming.
Yes.
Okay.
So this is what I think follows, because in the big picture, so if you really look at it, you've
That
actually
ties in with yields going down, metals going up, and risk on.
Yes.
All right, I'm getting your narrative now, buddy. All right.
So this is a really long-term chart. We're looking at 20 years of USD JPY. So this was a fourth, fifth, we bottomed here, and then we are doing some kind of a large A, B being a triangle.
Yeah.
Okay. And I'm presuming C is done. Now, of course, C is short. Some people can argue that, well, C didn't achieve equality to wave A.
Yeah.
But it did get to the fourth wave zone of the previous move, and that's sort of sufficient. What makes me also more confident of that is looking at the USD GBP, which is the British pound, because the GBP has touched this trend line of the highs, and all the moves prior to that are a series of three waves here, another three here, and similarly here. So I think we may have completed something big here, very long term. And that means
so you think the high is in the pound? Is this cable we're looking at?
Yes.
So the 126, 127. So although we could see a new low in the dollar, we've already peaked in cable. It doesn't compute for me.
No, this is so this is the USD GBP. It's not the GBP USD.
Okay.
Yeah, it's the inverted chart.
Yeah, all right.
It will look like this.
I forgot to hold the mirror up. So anyway, okay, I got you now. All right. So big move coming in. Yeah. All right. So the sacrificial lamb to get really, that's a key. Do you believe this? And you're a wave guy and you look at a lot of instruments. If you get the dollar right, you get the whole board right.
Pretty much.
Okay.
That logic has worked at least for the last 20 years.
Oh, 20 years. That's that's long term. So,
yeah.
Okay.
Yeah.
All right.
So I was trying to show you the Russell just before I go to India. I was trying to show you the Russell and the US bank index, two important indices, because that's where all the trouble has been. This is the Dow Jones Bank Index.
Yeah.
Okay. This is one large ABC correction. One can even look at the KBW index, where actually you have equality between A and C. In this, in the Dow Jones Bank Index, C is a little shorter than A. But C looks complete because we have wave 1, 2, 3, 4, and I was just waiting for the fifth to be done. Last 2 days action makes it look like the fifth is done, because it's recovered pretty much above the low of wave 1. So I'm truncating the fifth here and thinking that the worst is probably over for the bank index, which means you're actually looking at the bank index giving you a good rally ahead.
You could get one more low for a 3 drive to a bottom. Is that possible still to have one more low? Even though it looks great. You see what you have labeled 3 in March. That's drive 1. Then you had drive 2 in May. But
if we form an ending diagonal,
yeah,
which means something like this.
Yeah.
That may be a possibility.
Yeah. Okay. Just wanted to know. Yeah, you call 3 drives ending diagonals. That's correct. Okay. And go ahead. I know I've
And the second is the Russell. So the Russell 2000, which is the standard short for everyone who's sort of looking at US equities being bearish, has made multiple bottoms at the same price range, I think, since June of last year. So once, twice, thrice, and this is the fourth time. So I was watching this very closely. Does it break this line, or does it start recovering? Because if it starts recovering, then I can actually argue that this is complex W, X, Y, X kind of Z, something completing here in a very complex retracement. In fact, we may have even done, well, not 61, but 50%, a little more than 50% retracement.
And look what it held. If you go back there again, it held the pre-COVID high. Exactly.
Yes.
Right there. Look at that. Yeah. Okay.
So the last 2 days jump up, I think, is an early sign that it doesn't want to break down.
Yeah.
And that means this is all corrective. And in fact, this could be an ending diagonal over here. And we could have started 1, 2, and 3. So this is sort of a recovery starting here as well.
Okay.
So 2 of the weakest segments, once they start to turn, I think then you get a much more broad-based recovery in US equities. That was my main point. Now taking it back, so what have we been seeing in India? Now in India, sentiment again, this is the volume of puts traded relative to calls. And the reading we actually got in at the March bottom, this is the highest reading since 2008. So it's actually an all-time high reading because we have data only from 2012, 2002, once F&O futures and options trading in India became prevalent. So in all the data, this is the highest reading, which means maximum number of puts being traded relative to calls. And that to us is a sentiment extreme here that possibly the second wave, which I've been talking about, that we are in a wave 2. When we spoke a year back, the question was, will we get a deeper retracement in wave 2? Now with this sentiment extreme, it looks like instead of deep, this has become a consolidation, which is a complex correction, W, X, Y, I'm saying, and possibly complete. So I'm saying wave 2 is over, the consolidation phase is over, and we are probably ready now to start a larger degree move to the upside.
Okay.
The same is also seen in positioning. This is positioning by domestic institutions that were significantly long into the bottom in March based on this very same data. A lot of this data I'm showing, these charts come on a platform that we are building for data, which is being called Strike. Not yet live, not available to everyone yet. Should be in another week or 2. So this is the chart of the Nifty.
Is it going to have all the Elliott labeling on it too?
No.
Okay.
Elliott labeling is hard work.
Right.
This will be more of a data analysis software.
Right.
So it will have a lot of the data which is available in India.
Okay.
That people can plot, maybe breadth, swing, various other things.
Okay.
So now this is the big picture scenario for the Nifty, which is that we are done with this complex consolidation. Complex patterns are typically seen in 4th waves, which is why I'm calling it a 4th, which means 1, 2, 3, 4. And we are going for the 5th, which means on a 1 to 2 year basis, if all else works, which is you get the weak dollar, you get the risk on. The 5th wave for the Nifty could be back to the top end of this channel, or best case scenario is where the 5th wave is almost equal to the previous wave. So we're looking at something at at least at around 35,000 on the Nifty, but a little long term. So you need to keep 1, 2 years ahead.
Good times ahead for stock investors in India.
Yes. In fact, I think the index itself doesn't reflect the kind of moves we're actually seeing in individual stocks because of the investments the government is making in the capital goods sector. So we have the capex cycle kicking in. You have a lot of manufacturing being done there because of certain incentives to produce in India. So manufacturing of electronic parts, etc., are all picking up
because people are diversifying their production from China to India, aren't they?
Yes.
Okay.
All companies doing that, their stocks are doing exceedingly well, which is not completely reflected in the large cap index. Now, this is another angle to look at it. When I measure the quantitative cycle or the long wave in India, I do a Sensex to the CPI inflation ratio. Sensex is the other index for Indian stocks, just to get, and it has more history, which is why I use it. So we try to get an idea where we are in the cycle. So I say this is the spring, which was a huge long period, actually goes way back than the chart itself. And here it went through a long consolidation phase. I would call this the summer because it was associated with very high inflation and interest rates in India, which then dropped significantly after 2003, which is where the autumn starts. And so you had this big bull run. Subsequent to that, we've had an NPA problem, non-performing assets in certain sectors in the banking sector, which were cleaned out during this phase where it's underperformed relative to inflation. And from the COVID lows 2020, we are starting to see it beat inflation once again. So, which is a very good sign. So I think the previous phase of getting rid of the bad assets essentially and writing them off the balance sheets is over, and a much more cleaner bull run is being seen. And a lot of these sectors that were in trouble also are now beginning to participate. Everything from power, energy, capital goods, they were all underperforming the market between 2010 and 2020. And you're only doing well in defensives like FMCG, pharma, and technology. Now you're seeing a much more broad-based advance where everything is participating. So, which is where I think we are actually consolidating above the breakout point on inflation, and I think the next move continues.
Okay, what a great presentation as attendees.
So these are key levels. I think people who are a little bearish will continue to watch and think, oh, is this still an ending diagonal? So they'll be watching 19,035 for a breakout. And if they're thinking that this is an expanded flat, A, B, then they'll possibly be watching 19,900 because a lot of people are still concerned because of the global cues. And so these are going to be two key levels which will help us get rid of those possibilities. And once we are past 19,900, I think then the bigger targets that I'm talking about will become more apparent.
Okay, Rohit. Well,
and this is a very, very short-term hourly setup of the Nifty, really drilling it down. We are looking at the first impulse from the March bottom. Right. So we had our first wave, second wave. The last few days, we saw the fourth wave pulling back till today. Today, the markets closed positive. It actually held the 20-day average and the lower end of the channel. So I'm sensing we start 5 up, which should head towards at least 18,700, 800. Or if it overshoots a bit, maybe touch the 19,000 mark, which we saw in the previous chart, that trend line of the highs, and possibly stop there for maybe some consolidation.
Well, you have your narrative has no fear, and definitely the acronym for fear is false evidence appearing real.
Wow, that is fantastic.
You can use it. So anyway, really great presentation, and I think it's the most bullish I've heard you since we've been talking.
Yes.
So dollar weakness, risk, there's nothing really to be short. Looking for bond rally, stock rally, metal rally, foreign currency rally, commodity rally, global bourse rally.
Yeah.
Okay. All right. Well, the glass is half full, and it's going to overflow, according to Rohit at India Charts. And for you to stay on top of his work, follow him initially, and want to show your website, Rohit, before we call it a day?
Yeah. Yes, so people can simply move over to indiacharts.com. We do a couple of things so far. I write content every day on most of these markets as they evolve. We continue to show the setups that we're really looking at under various segments. So people can simply click on whatever they want to see, whether it's the Nifty. So we have actually done a video update here. And if they actually want to, educate themselves about all of this, then I do a mentorship program, which is pretty extensive. Not a 1 day, 2 day session, but this runs for 3 months, 3 hours every Sunday. Somebody wants to learn from scratch how to look at charts, how to do Elliott wave analysis, and then how to actually execute a trade, generating the trade setups. That's kind of a comprehensive program that we do. And the third thing which we are working on, I did show screens of the software, which is going to be called Strike. It'll be on a different website, which will be basically data analytics.
Okay. All right, Rohit. Well, thank you so much for being flexible to adjust. First it was the power, then I double booked a day, and with the week we had in the market, really confirmation to people that are skeptical about what's going on right now. I needed it too. So again, thank you, my trading warrior brother. Good luck. I root for you, and let's get back together in this later in the summer, see how things are shaping up.
Surely. Thank you. Thank you so much for having me.
Okay, Rohit Srivastava, help me with your last name. It's
Srivastava. Yeah.
Srivastava.
Yes.
Okay, got it. And at India charts, easy to remember. Follow this man. Thank you, Rohit.
Thank you.
All right, buddy. Have a great weekend. Talk to you this summer. Good hunting. Okay, everyone enjoyed it, Rohit. Everyone that's still here, you join the team in 5 minutes for the morning edge. Have a great weekend. Don't just count your pips, count your blessings.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.